happens when you default. Today I have two guests who are very versed in this area from two financial institutions, GK Capital, Dennis Robinson, and from JNFB, Shani. Duncan-Falconer. I forgot the Faulkner. Okay. So very nice to have you both as we discuss this topic. So let me just ask you, each of you, to just give a quick introduction. Tell us what you do at GK, Doug.
Sure, thank you, Sandra, and thank you for having us. I'm Douglas Robinson. I'm head of investment banking at GK Capital, and so I guess you could say that I am responsible for all of those wonderful IPOs that you see from us.
And you, Shani.
I'm Shani Duncan-Falconer. I am the head of the SME Resource Center. So with what we're going to talk about today, I help clients not reach a default rate.
That's really good, yes. All right, before we get into the whole business of defaulting, Doug, why don't you tell our audience about the range of financing options that GK offers?
Sure. We really do run the gamut from debt to equity to anywhere in between. So, at GK Capital, we provide equity financing. We actually have a small private equity portfolio that we have managed. We provide debt in the form of margin debt, which can allow you actually to invest more backed by shares that you have listed on the stock exchange. And we also provide something quite in the middle, mezzanine financing, which really can help businesses to grow. And I should also mention that as a part of the wider Grace Kennedy group, that our clients and the Grace Kennedy clients have access to First Global Bank and traditional banking sources as well. So we really have a wide range of services.
And what about JNFB? I imagine it's pricey.
We have a wide range of services. It's because we have banks, so we start with a life cycle. So we have our SMEs, and then we go to we have corporates, and then we also have our private equity, and then our cap market. So we have a full range for our business clients.
Yeah, two very solid financial institutions in the ecosystem in Jamaica. So, Don, let me ask you, what's the difference between private corporate financing and traditional corporate financing?
Sure. So when you look at traditional financing, and let's just take bank debt as an example, right? What that tends to look like is, first of all, they ask you, what collateral do you have to give me? And please make sure that collateral is real estate or real estate adjacent. And you have your traditional interest payments and principal payments that are due either every month or every 3 months. Maybe they'll give you a reply for a year or so on the principal payments, but you have to do some sort of amortizing schedule, and it generally looks something like that.
It's that kind of vanilla.
Exactly. But on my side of the street, the corporate finance side, we can be a little more flexible and so tailor it exactly what you need. On the collateral side, we can say, yes, real estate is great, but we can try and look at other things like perhaps shares or other tangible sort of assets. And we can also look at structuring the financing, the actual financial terms to work within your budget, right, and what you need. So for example, maybe we say to you, don't pay any principal over the term of this facility, pay it at the end, and what that will do is to allow you to instead take that same cash you would have paid to the bank and reinvest it in your business and grow at hopefully a faster pace than you could with
So I'm sure there are instances where private corporate financing is a better option for a company.
100%. I mean, what's great is that we can fit it to exactly what you need, but also, to be honest, there are situations where both can work, where the private is the best option. There are also situations where the traditional is the best option because, for example, if you have a fixed set of cash flows that you're going to make over the next 10 years, it makes a lot of sense to be able to every month say, you know what, let me chip away at that principal balance that I have. So, it's all about what your specific needs are.
And is there any stage of the business? I mean, well-established vis-a-vis a young company, is that a consideration in deciding whether corporate financing is
that's that's most certainly a consideration, and I would say maybe 8 times out of 10, the younger you are, the more likely you want to go the traditional route. Of course, that doesn't say that an equity investment or a specific type of special purpose vehicle that's been created for a project makes a lot of sense as private financing, corporate financing, right? But that's definitely a big consideration.
Right. So let's look at how a company qualifies for corporate financing. What are some of the considerations in terms of assessing risk and looking at governance structures and what they want to use the funds for? What goes into making that decision?
Certainly, and I think you're actually going to see a lot of similarities between the corporate finance and the traditional financing side at this, because the assessment really is the same, right? We need to look at the people behind the business. Are we comfortable with the management team? Do we think that they have been doing a good job or continue to be doing a good job? Do they have the resources in place to ensure that they can meet whatever reporting requirements that they have? Because no matter what kind of financing we're getting, we're going to need to report on whatever monthly basis, a quarterly basis, an annual basis as to certain things, requirements that they need to meet. Also, the governance that they have in place, what kind of checks and balances do they have for us as investors or us as lenders to feel comfortable, right? Also, we need to look at the financial side of things. How have we been doing? Have we been making profits? Have we been growing? Do we expect to continue to do so? And finally, what collateral considerations are there, right? Do we want to look at, is there real estate available, something else available? Is there nothing available? And all of those things come together into that assessment for us to figure out what makes the most sense.
Yeah, talking about collateral, banks often think about the traditional kinds of collateral, fixed assets. What about the newer types of assets, like intellectual property? How could that be factored in?
Intellectual property, that's an interesting one. So I would say that the Jamaican capital markets are still a little risk-averse, right? So intellectual property specifically, perhaps it could be included within a broader package, and most definitely there would be some sort of, we call it a haircut, in terms of what we expect the value of that intellectual property to be versus what we count it as collateral value. But it's something to be considered, because at the end of the day, even you could see there are bonds and securities out there that are actually unsecured, have absolutely no collateral underneath them, at least tangible collateral. So really and truly on the corporate finance side, there is quite a bit more flexibility around collateral.
Yeah. And what about founders negotiating the terms? How much leeway is there for negotiation?
Well, I will say this to you. I think everybody that sits in my seat knows that when we start the conversation, that's not the end of the conversation. There is going to be exactly. There's a lot of negotiating happening, and whether it is on interest rate, on collateral values, and what type of collateral, tenor, everything, right? So yes, there most certainly is a lot of room for negotiation, but we all have our parameters that we need to work within, and we all figure out a way to come somewhere in the middle and find a happy medium.
Yeah. So Shani, Duncan talked about corporate governance being one of the areas that they look at. What are some of those governance considerations that would need to be taken into account when you're looking at private corporate financing?
Right. So definitely at GMMB, we take that seriously. So what we do is that we have to look at the processes and what you have in place. So for instance, we look at and see who are your board of directors, what are their qualifications, does it span a wide range. Then we also look at executive management. Who do you have on your executive management team, what their salary structures look like, is it in line with the industry, making sure that that is done properly. And then we also look at the risk management. So what happens if something goes wrong? What are those policies that you have in place? Also, is it transparent? Are your financials transparent? Are we going to be able to get a proper review
when we have to do our yearly review, you know? So we have to look at all of those things under your corporate governance.
Okay. So I know that you had the resource center at JMNB, and is there technical support available to companies as they prepare for, you know, getting these kinds of finance?
Yes, definitely. So within the resource center, we have partners like you who will help our SMEs, because that's the SME resource center.
Right.
So if we realize that you need outside support, we have partners, discounted partners, who will put you where you need to be. Otherwise, our relationship managers, they are able to assess your business and be able to show you where you need to go. So that is for our SMEs. And then when we reach to the larger corporates, we have our corporate banking team, and then we have our cap markets team. So we have that full range, no matter where you are, to give you that advisory support that's needed.
Yeah, so if their corporate governance framework needs strengthening, their resources that you have.
Definitely.
What about that, GK? Is that?
that seems to be a journey. So let's get closer to this discussion about the default, you know?
The D word.
The D word. What measures does GK take to minimize or to mitigate the risk of default?
Well, I think another D word is very important, which is due diligence, right? So before you look at investing, lending, deploying any capital, you have to do that deep dive, and that speaks to a lot of the stuff that we talked about a while ago, right? The people behind the business, what the environment looks like for that business and that industry, as well as, you know, mitigating your downside risk. What collateral am I going to have in place for me or my investors to ensure that if the dreaded D word happens, that there is some sort of cushion and some sort of avenue towards realizing your investment, right? So there's all of those type of things you have to look at. Also, you have to look at whether it's putting in place certain metrics that you have to monitor on a monthly or a quarterly or an annual basis to ensure that you kind of are able to see the early signs of any issues. And, you know, so there are a lot of things. I could go on and on, but there are a lot of things that you have to do.
How important is it to, I mean, I know, you know, big businesses are generally able to produce financial statements on a monthly basis and be able to monitor that.
Right.
Is that an issue for the companies that you are lending to be producing those monthly financial statements and monitoring?
Hopefully not. That is the cornerstone of any investor, right? I need to know that within a reasonable amount of time I can assess how well or poorly you're doing, right? So if there is difficulty in getting monthly or quarterly financial statements, we know immediately that's a huge red flag. Right? So you have to have all of those resources, whether it's a CFO, an FC, an accounting team behind them, or external, whatever it is. And something that's also extremely important as we talk about accountants and finances are having those accounts audited, right? And making sure a third party who steps in says, you know what, we believe these numbers are accurate, and you can rely on them for whatever assessment that you're doing.
Yeah. No, I think that's a big issue for a lot of companies that don't really understand the importance of having those audited financials. So Shani, for a company that might be, you know, on the path or close to it, what are some of the what's some advice you would give those businesses to avoid defaulting on their?
Right. So as the company itself, the first thing you need to do is assess the situation. What is happening within your business that is making you look like you can't repay this loan? You can't do what you need to do. So do you now have to cut some costs? Do you maybe have to sell off some assets? How do you get more cash flow coming into your business? So that's the first thing. You do a proper assessment of your business. So internally first, and then you communicate with your banker. That is the most important.
Can't stress that. Eh?
Yes. Like, I always say, do not be afraid of your banker. If you're afraid of your banker, you're with the wrong bank. You know?
Right,
So you need to go to your banker and let them know what's happening. And then you have a plan and talk to your banker about that plan. So in terms of restructuring that loan, and the bank is always more favorable to restructuring a loan than having it go to go bad. We don't want it to go bad. So those are the things that you need to do. You need to cut your costs, you need to talk to your banker, you need to assess the cash flow to see where you can get in more money. Because maybe you have outstanding
receivables.
Yeah.
I mean, that's another challenge for a lot of businesses.
Right. So how do you bring that in? How do you bring more money into your business without having to go into default?
Right. Yeah. It may be that there's some new service you can offer.
Exactly.
Yeah.
Exactly.
Right. Yeah. I mean, that is the crux of it. I think really doing that, continually doing that assessment.
Yes.
And communicating. So let's talk about negotiating, renegotiating. How open are financial institutions to say adjusting, rates, interest rates, the tenor of the loan?
Well, I feel like a lot of people will tell you that financial institutions are very happy to adjust those.
Facilitating changes to ensure that we don't get to the D word.
Right.
We have to be open, and we have to, it has to be a reasonable sort of situation. We all have to sit down and say, you know what,
there are some issues here, we all need to assess, and if we can find a viable path to a situation that benefits both the lender or the investors as well as the borrower themselves, then I think that's a win-win for everybody.
Absolutely. Yeah. So I think, the bottom line is for CEOs, the owners of the company, the managers, to really act quickly and decisively if they see that this is the path they're going to take. So I want to ask you, Doug, because, I sit on a lot of boards, and, I don't think business owners really, when they have directors in their companies, understand the risks that they're putting those directors at when they default. What are some of the implications of defaults on say, your directors?
On your directors. Well, the first one, the biggest one that comes to my mind is that as a director, you are liable for all of these things. So if you look at certain other issues that may have happened to companies in the past, if you notice, when people have their grievances, they don't just sue the company. They also sue the directors because the directors have personal liability there. And that's actually why a lot of companies will include liability insurance, directors' liability insurance as a part of that package. But it's very important to understand as a director or somebody who's considering becoming a director on a business that you have to make sure that you feel very comfortable with, again, the people behind the business and what they're doing, because you are now on the hook, right? So it's, yeah.
And I mean, it even goes beyond being sued. It's going to affect it could affect your credit worthiness, right?
Of course.
Your credit score.
Yes.
I mean, I have actually met people who then try to get a personal loan and they're unable to because a company on whose board they served has defaulted on a loan, and then it has implications for the directors.
Most certainly, it really does. And that credit score thing is actually, it's not even at the director level as well, it's at the company level also, because what you notice is nowadays, maybe back in the day this wasn't so out there, but nowadays every single loan, every single investment comes with a cross default clause. So if a company defaults on one loan, it's as if they've defaulted on everything. And so all of their lenders, all of their investors are going to come and say, hey, what's happening, you know?
Yeah. So let's talk about the process that a business goes through when it defaults on a loan. What actually?
Well, as you said, and we hope that the best case, first of all, we hope that we never get there. Don't default, please.
That's the bottom line.
Right.
But if that happens.
If it does happen, first of all, the most important thing, and Shani said it early, is communicate. Communicate clearly, communicate well, communicate early, and communicate a lot. Right? And because what we need, right, I think as a borrower, as an investment ecosystem, is to ensure that we have a place where, you know, it's not simply, I have defaulted, oh well, I guess you take my collateral, right, and hope for the best. Because that is the worst case scenario, and that is where investors can lose a lot of money. Businesses can get themselves into a lot of trouble, as we've spoken about before, and you know, then as an environment, we start to pull back and get a lot more risk averse, and you don't have the growth that you really want to have as an economy, as you know, just business sectors. So hopefully you're able to communicate and come with some sort of a plan, right, to say, you know what, we are having difficulties, but here is what we think can work. One, for us as borrowers, if you, I don't know, extend my maturity, give me a little more time to pay, maybe even change how the interest is paid, maybe a part of it is paid in cash, a part of it is collateralized, or however it is, right? There are a number of different things that you can do. And you need to, we talk about negotiation, you know, negotiate with your bankers, with your investors, to hopefully have them, both parties, come to a happy medium where you say, you know what, first of all, the investors need to say, you know what, I accept this. I believe that this plan is credible, and that you have actually put something in front of me that makes sense and that is doable. And then you're able to slowly but surely get yourself out of what is, of course, a very difficult situation.
So, I mean, I think that's a really important message, that the financial institutions are prepared to sit with you and work something out. Because, as you say, it's a win-win for everybody if they work it out. But I think we also need to get real in terms of what are some of the legal ramifications of somebody defaulting. What happens in the legal sphere?
Well, I mean, on the legal side, you know, we talk about collateral being monetized, right? I, as a lender, will have the right to well, I don't want to call it ownership exactly, but take over that, whatever assets they are that are in the collateral package, try and monetize them, try and sell them, so that I can get back my return, and we can all part ways. So that's the first thing. But also, as you say, you know, there are ramifications on the business itself, the business owners and managers rather, and the directors, in terms of, you know, how did you get here? What actions were taken to get here, and depending on, you know, how those are found, there are various legal ramifications for those.
Now, I would imagine now the sort of ultimate thing is to take somebody to court.
Yes.
What is that a decision that a financial institution is perhaps likely to take?
Well,
it's under what circumstances?
Yes, so it's one that most certainly the financial institutions are willing to take. But I think the most important thing for when coming to that decision is to kind of treat it like a last resort, right? Because sure, that can go through and you can go down that avenue, but I think in practicality, we all know that it's going to take a lot of time, a lot of effort, a lot of resources, and not just money, but just, you know, people's time and focus and that kind of thing. And it's never, they're always, you know, things that happen in court and take forever and what. And we don't want to go down that route, right? What we really want, again, is to come to some sort of common sense solution that works for both parties, so that we don't have to take let's use the carrot, not the stick, right? So we can figure it out. And at the end of the day, that then helps the business owner, the borrowers, to not have that bigger blemish, shall we call it, on whether it's their reputation, their credit score, their ability to get even more debt and attract more investors. So, the best case scenario for all involved is coming to a solution, assuming that one can be had, because of course there are going to be situations where, a business just fails.
Yeah. And I mean, we can't stress enough not getting to that point.
Yes, please, don't get to that point, folks.
Because then there are other implications as well. If you have defaulted on a loan, you're probably not likely to get another loan.
Very much so. From anybody.
Right?
Yeah.
So that's a situation to avoid at all costs. And I just wonder, how do other lenders actually know that you've had a poor
that's a good question.
Banking secret do financial institutions share this kind of information?
Well,
is it the credit bureau that would indicate?
Yeah, I was about to say that, we're moving ahead, right? In Jamaica, we now have our credit bureaus that information is shared with. So you can actually do credit reports on both companies and individuals to know kind of what their credit background looks like. Have they had any issues, whether it's credit card issues or big debt issues or anything like that. Also, when I as a borrower need to go and find some more money, borrow some more funds, and if I need to provide things like, sometimes you'll ask for references from your banks, so your banks will say provide some information on that. So there are a number of avenues to get that information, and also especially if action is taken, legal action is taken, that now is in the public sphere, and you can actually go search that on the various legal courts. Exactly, even Google, exactly.
When it gets to the point of even having a judgment, you will definitely be able to find that on Google. So we've had a lot of discussion here today, and I'm just wondering if anybody in our audience has questions for us. If you do, please write them in the chat. And I think we have a couple questions coming in. So I think, Shani, we had talked about this earlier, but it bears repeating. The question is, from a strategic perspective, what measures can companies take to minimize the risk of defaulting?
Okay, so as you said, we spoke about that, in terms of making sure that you assess the situation. When you look at the situation, make sure that you're able to cut costs, look at your cash flow. You go to your bank, you try to renegotiate that loan that you have. So whether you're looking at the term of the loan or whether the interest rate, so you talk with your banker in terms of what works for you and what works with the bank. Don't wait until it has gone bad. You go and you have a proper discussion with them.
Yeah. And we have a question from Shamar Green, which is in the same vein. So the focus is more on working with companies to pay or restructure the debt rather than declaring default and collecting collateral. I think a resounding yes.
Most definitely a resounding yes, because in order to go to that last resort situation where you're collecting collateral, there is going to be a lot of time taken to go through the courts, do your various, you're going to have to go to auction and get everybody, all sorts of people involved, and whenever you're doing that, the buyers of these assets will know that these are distressed assets, and so again that will cut down the price that you're able to get for it. And so the question is, when I go down this route, one, how long will it take, and two, how much of my or my investors' money will be recouped? And honestly, most of the time, the answer is not 100%. So you really want to try and nip that at the bud early, try and figure out the best way forward so that everybody involved can proceed. The business can continue to do what it needs to do to get back into a good position, and the investors or the lender can do what it needs to do to eventually get back its principal along with some sort of return.
So there's a question here about collateral and what kinds of collateral would be taken. Would that include somebody's home?
Well, the short answer is yes, it could include somebody's home. Actually, banks love to take homes as collateral. That is the first collateral that they really want to get.
Yeah.
Exactly. But you know,
You're likely not to want to lose your home.
that too.
Gives you incentive to
Yes.
keep the payments.
Certainly, but there are a lot of types of collateral that we can use. As we said before, general real estate, whether it's homes, land, the various development, you could look at shares listed on a stock exchange, because that you can actually see the value. You could, depending on the strength of the business, there are some businesses out there actually borrowing unsecured debt, but that's because the lenders have extreme confidence in those businesses.
And the company would have a track record, I would imagine.
Exactly, a very long track record of profitability, of growth, and of paying back their debt. So that's something that's important, is for you to show that as an individual or a business, you have taken on debt in the past, you have met your obligations and met them in full, and that really goes a far way to proving or to convincing folks that, you know what, you are somebody that we can take seriously and invest in.
Yeah. So a question from Melissa Case. Shani, let's throw this one to you. How do economic conditions and market trends affect the management of corporate debt? And is there a way to predict this?
All right. So, we know that in the economy, say COVID-19, things have happened, and we could not predict it, right? So what we as the bank did, we would extend moratoriums. We would make sure that we put things in place for if these things happen.
Yeah.
Sometimes businesses fail. Sometimes the economy does not go as you would have expected. So we have to have mitigations to deal with those sorts of things. So it's not to say that because something went bad, that we're just going to say that it's over.
I think that COVID experience is a really great example.
Yes.
Because, having been associated, I sit on the board of NCB, extending those moratoriums.
And we had to do that at JMMB.
Businesses.
Yeah.
Oh, of course. I'm sure both JMMB, GK, we had to support our businesses, right? Because COVID, as you say, is something that nobody could have predicted. It is quite literally the definition of force majeure, right? And so we had to try and figure out how can we support everybody, get them through this time, and when things come back, then of course we can figure out getting back to normal.
And then also too, that goes back to corporate governance and risk management.
Sure.
So you have to plan for these things and the eventuality that something may go wrong, and have the different scenarios. So it's very important for a company to do that. And we as the banks look to see what you have put in place.
And monitoring things like, inflation. Interest rates.
Exactly.
To see what those trends are and how they might affect your business. So having strong risk management in a business is a really important thing.
Yeah.
And for the board, which is really, that's one of the principal jobs that the board of directors has to do, is to manage the risks that the business faces. So I think we're coming close to the end. I don't see any more questions. I don't know if, okay, so yes, we do have another question from Shamar. So in a high inflationary interest rate environment like this, which makes securing funding more costly, what problems do you foresee for both lenders and borrowers? That's an excellent question.
Shaman.
That's interesting. Problems. I don't know about problems, but what I will say is, first of all, of course, you mentioned the cost of debt, the cost of financing. That is very high at the moment, a lot higher than it has been in the past. We've been very lucky to have low interest rate and low inflation environment. So that's one issue right there. What that means, of course, is if you extrapolate, if my borrowing cost is higher, that means I can probably borrow less, and so I can afford less, whether it is capital expenditure, less spending on growth, and so there are those issues that come with it. Then the other question is, okay, is there another source of financing that I'm going to look at? Could I look at, I don't know, listing my company on the market or doing some sort of private equity transaction? No, the textbooks will tell you with higher interest rates come higher cost of capital and come lower equity valuations, right? Which means that, sure, you can still get the money that you want, but there's a trade-off. Either you get less money for the same amount of dilution, we call it, the amount of your business that you sell, or you get more money, but you sell more of your shares, right? Or so it's really a cycle.
Isn't it the essence of good management?
Yes.
Monitoring these things, because you will always have these situations where external forces are going to impact your business.
Almost certainly.
You have to be constantly monitoring them to make sure, and then develop strategies to mitigate those risks.
Absolutely.
Well, this was a fun conversation on a not so fun topic. So I want to thank you, Doug and Shani, very much for spending the morning with us to talk about this topic. I hope that our audience learned something today, and I want to thank you all for joining us. And to say that I know that Karaya is planning to have a lot more of these webinars, and even on today's topic, we all acknowledge that we could have gone for another hour at least talking about it. So I want to thank everybody for logging on and listening and sharing your questions, and we'll see you next time. Bye.